Welcome. Thank you for joining me. I'm Sharon Constançon. I'm Chief Executive of Valufin, and we are building a series of instruction webinars to help financial directors to understand the complexities of foreign exchange and just to give some key points on some of the things they need to consider when looking at the different elements. Being as big an element as it is, being so complex as it is, we have broken it down into 7 components. And today we are working with the 5th component, which we have given the word find. Find being F in the framework of Valufin. The reason it's so important that we are addressing these complexities of foreign exchange is that every business is absolutely unique. And unfortunately, the amount of training that is available to companies on Forex risk management is extremely limited. So it is important that we do make sure that we are up to date and we can learn as much as possible about our business, which we've covered in a lot of the sessions before now, but equally about the market itself, the instruments available. So today we will take another look at our human behavior, what some of the instruments might be, but in a very simplistic way, and some interactions between the volatility, complexity, and people. So even though you may have some degree of training, you may have worked in some foreign exchange environments, you may well have worked with a provider, but now that you're sitting as the treasury manager, finance director, financial manager within a business, all of a sudden the decision-making changes. And it changes in every single business. It changes year to year, depending on market trends, where the business is at in its business cycle. So it is important that we support treasury managers, whichever role they might be taking within the business, to ensure that they actually can get to the right outcome. You can never beat the market. You can never be 100% right all the time. But what we can do is, on average, make better decisions than we might otherwise have made if we'd followed some form of strict policy. And this is often one of the problems that we have in the market. So using our mnemonic Valufin to help create some structure to your thinking, it allows you to take the 7 elements that you need to consider and break them down into the individual parts, and you can work systematically through all of these elements to determine how you are going to manage your foreign exchange. It does give you the tips and the clues in this, but these will be followed by more detailed articles and a book that will go through these elements in even further detail than what we are going to cover today in a short 45 minutes. So focusing on find. Find is the area where we are going to look at the portfolio. We're going to be looking at how we can consider some of the risks that we are creating, some of the instruments, and how we are going to humanly interact with all of these elements. Across all of the stages that we're going to cover today, we need to consider the human element. It's you. It's who you work with in your organization. It's your board. It's your risk committee. It's your treasury committee. It's your governance committee. It's where policies are made. It's where decisions are made. It's where all the element of knowledge or lack thereof, or about your business. And all of that needs to be considered to make sure that you are making the right decisions. So the human element comes in where we are looking at the portfolio, which is the first element, the ratios of cover, the second element, the risks we create, the solutions we can look at, the structures we can put together, the utilization strategies we might want to follow, who we're doing these transactions with, and then as the acting treasury manager, how are we influenced to ensure that we, first of all, protect the company, but most importantly, do we make the right decisions most of the time? So let's look through those elements in more detail. Let's manage the portfolio. Now, the portfolio is probably contained mainly in the lesson that we had, the previous one, which is where we were looking at understanding the business, looking at the supply chain of the organization. So at this point, we are going to be assuming that knowledge is given at the point in time and that we know about our business. So if we know about our business, we're going to understand to what extent we import, to what extent we export, what are our order lead times. We covered this in detail in the last session, shipping lead times we did, and at the point at which risk transfers. Now, every business risk will transfer in potentially different places in that chain, from concept that we're going to do business internationally to we have passed the product through our entire chain and we're now at a financial year end and we're recording our net profit. The credit terms that we are offered by suppliers or we offer to our customers, the currency mix. Now, a lot of companies that import or export will tend to use their home currency. In other words, not creating any form of the risks we are dealing with today. But in many cases, you can't do that. And if you think about it, in the case of trading internationally, one of you will be potentially in home currency, the other therefore won't. So 50% of the time, you are going to be dealing with a foreign currency transaction. Seldom do both work in another third currency. It does happen. It happens in China. It happens in Africa particularly, where they will use the dollar, even though their currency might be rand or renminbi, and the other currency might be euro or euro or sterling, but they agree to use the dollar as the transaction. So we do see it where both parties are going to be involved in an international transaction. We also have the degree of natural hedging, which is, in some people's understanding, something that happens regularly, but in reality, a pure natural hedge isn't often happening. It is invariably displaced by time, by interest rates, by market conditions, volumes of the flows, timing of the flows, invariably negates a natural hedge. Doesn't mean you don't have it, but you need to do things to create that natural hedge as a secure hedge. So within the business as well, things that we've covered in previous sessions is we're costing our stock in at a certain rate. We're determining the sales prices invariably on another rate. We might have accounting rates on a monthly basis. Invariably, those do exist as well. So we now already have 3 rates that we're going to be working with. There are often other rates that exist in the system. In terms of the systems that we run on our FRM system, is we allow for 14 different rates that can be attached to any one given invoice, allowing you to manage the cloud that accounting causes. And we've covered this in a previous session, the gray area of what profit did we actually make, and making sure that we understand how the goods and the rates and the business are correlating. So then we also look at market share. What is our market share? Are we a market leader? Are we a market follower? Are we the smallest company trading in that widget in that market? Those will make a difference to our risk profiling, our risk appetite, and our behavior in the Forex market. Another element is our competitor working in a different currency to us? So you might find that one company is importing from Japan, another company is importing from China in the US dollar. And you'll find that the yen and the dollar, therefore, are behaving differently. And the dollar, particularly being a safe haven currency, can have a large degree of volatility that does impact other currencies as a corollary, but invariably is a leader in some of the market activities. So you can find that you will end up at a disadvantage or an advantage to a competitor if you have got different currencies in which you are importing or exporting. Your accounting policy makes a big difference to the way numbers are reflected. Doesn't make a difference to what the business makes as a profit or loss, but invariably you might not be able to find that answer unless you're doing all the things that we've talked about over these sessions so that you can identify the differences between a business P&L and an accounting P&L. So we look at our Forex policy. Now, invariably, that's quite a restrictive policy. The result of that is people then say, okay, well, I actually put in the policy, and if I didn't do the right thing, it's not my problem. That's not doing the right thing. So we have to make sure that our Forex policies, and we'll talk about that in a moment, are applicable to the business. We also have to look at risk appetite. Many risk committees, boards, financial managers are often risk averse and therefore not allowing the Treasury team to actually do their job properly. And the amount of Forex knowledge we have in amongst the people that are involved in the decisions in the organization. Invariably, that knowledge is lacking, and it's lacking because of lack of training, lack of exposure to it, the uniqueness of the business in this specific environment, and it's not the day job of the individual. It's something they do when things impact them, when markets are volatile, when there's a new customer or there's a new supplier. So it's something that is more ad hoc than the day job. We're also dealing with market rates, trends, volatility, and the fact that we are invariably working through everything being the US dollar. Now, some companies actually will break up their Forex management and do the sterling to the dollar, dollar to the euro, if they are trading euro sterling. Doing that, if you're in multi-currencies, can be extremely beneficial so that you're managing your home currency to dollar across everything in a managed way. It does create it does require a degree of management, proactiveness, and invariably can be extremely beneficial in working through the currencies. But if you're on a single currency pair, it adds very little value. It's only where you've got multiple currency pairs, and also if you have imports and exports, that you're able to break things down from the dollar to your home currency, that allowing actually to bring in some natural hedges that can exist within the portfolio. So very valuable opportunity that you can manage. Now we have this issue of ratios of cover. I've seen everything. I don't think there's a story I can laugh at or be concerned about, or actually think I didn't know there was anyone I hadn't come across. But I've just listed for you here just the extremes of what we tend to see. So, for example, some companies will say we are 100% covered, therefore we have no risk, therefore we've got nothing to manage. Other companies will say we don't cover anything, therefore we have no risk, therefore we have nothing to manage. But actually, those are the two most high-risk ends of the spectrum. If you're 100% covered, you have no ability to manage the exchange rate yesterday, 5 minutes ago, to tomorrow, or in 5 minutes' time. Now, a lot of companies say, well, the only thing we can do in Forex management is to get a better rate. Now, hunting down the best rate doesn't work for good relationships with your suppliers. You waste a lot of time and energy for a minimal value add. And what is far better is to agree with your suppliers what your margin is, and you stick to it, and you manage it, and make sure it is stuck to. That way, you actually save money overall than trying to hunt down a few more pips. So we're saying that you can make a lot more in a range of time than you can in just managing a rate at a moment in time. So you could make 2% in a day or a week, but you're not going to make 2% on hunting down a rate. If that is what you're doing, you're going to make a difference of 0.02% or 0.2% at most. And you don't see those as large margin differences because you're doing it all the time. If you did it for the first time ever, it could be a phenomenal difference. And working recently with some of our customers, we've noticed that when we engage with them as a new service, we often find that margins are a lot higher than they would have even imagined. So the initial thing we do is we do get the rates down to better levels, but then you are not hunting it down thereafter. The job's done. It stays now. You manage that margin. So we are more concerned about looking at what is the right ratio of cover you should have. And there is no right answer. This depends on your cycles, your order cycles, your payment cycles. If a company is working just in time and they're ordering week by week by week, their risk cycle is very different to an organization that is manufacturing a fashion item that comes into the stores 18 months from concept. That cycle is very different to somebody who's bringing in component parts and they arrive every week and they are costed every week. Very, very different business, one to another. If you're looking at your foodstuffs or agriculture in comparison to heavy equipment, they're going to be completely different again. So we see a very typical one we see is 75% of and I use the word season. It could be a half year, it could be a quarter year, it could be of invoiced value, it could be of anything they define. Now, unfortunately, we see a lot of Forex policies that say 75%, but they don't say of what. And therefore, if you've got a treasury manager who is rogue, the risk is the policy will not stand up to any activity they do because it's not clearly defined enough. Sometimes it's actually better to provide a range for your treasury managers to work within and to have the right reporting and controls, rather to give them the best chance to do better for you and to pick up better spot rates when they happen, not when the paper flows. So it's important to work with the market at this point in time, moment to moment, than it is to wait for a piece of paper to land on somebody's desk. That's the critical moment in terms of policy. But in reality, that can be a day or a week delayed, and therefore we've created risk within the policy in itself. So we find a lot of companies are paper-driven or process or event-driven rather than knowing the business, understanding the business, and within parameters, working with the market, leading some of those many, many, many small decisions. If you look at foreign exchange, it's impossible that any one decision is going to be the right one. It's absolutely impossible. So, and with hindsight, today it looks right, tomorrow it looks wrong. Next year or next month, it looks right. 2 months later, it looks wrong. The markets are volatile, they move up and down, and we need to always ensure that we're working with many decisions in small amounts, that at any point in time, we're working better than the average trend of the curve. And at no point in time have we been prone to panic. Now, very often we see companies will say, I'm waiting for the best rate, and then miss it and end up with the worst rate, literally, where they've gone from the peak to the trough without making a decision. So we work very differently in that respect, and we'll cover this under the behavioral science section in a moment, to take out that element of human behavior that stops us doing the right thing. And it's all about the emotion of the moment, the greed of the moment. So if we look at time horizons, some organizations will find that their time horizon is quite short. For example, we make a payment on a Friday. We define how much we're going to pay on a Friday, on Monday or Tuesday or whatever. So they have some processes that make running their business practical and easier. So within Forex management, you have to blend into some of those processes, and in some cases advise on maybe making some changes to those, because it might be creating risk within your Forex management. But making sure that in those periods that you are able to make decisions that allow the company to maximize on rate movements in the short term. When we're looking at the longer term, it's very different, and our accounting policies are invariably going to be very different as well. And therefore, we look at costing in a different way. So time horizon makes a very big difference to the way we run the accounting element of our foreign exchange management. So it's making sure that we look at all the different elements as they are impacting our business. So the 0% covered, I'm driven by somebody in the payments department, cash book department, liquidity, availability, and I just work on the spot rate at that moment in time. 100% covered, I've been driven by an order that has forced us to then take cover at a moment in time. So just taking that further and just looking at two graphs. One is a short period of less than a month. We're looking at just over a week. So a week, almost 2 weeks. If you have a look at the volatility in the cable as it's known, sterling to the US dollar, and you see the degree of volatility we have seen in just a period of 10 odd days. So, and then if you see, you get spikes, you get what we call rogue pricing, that spike up there going up to the 128 level. That can be very beneficial if you had placed an order in the market, and you would have got that triggered invariably if it generally was priced and stuff moved at that level. But the reason it's showing there without the blue or the red is its time period was too short. It occurred for less than 5 minutes in the case of this graph. Now, if you look at that and you put that into the blend of a 2-year graph, can you see the trends all the way down and the trends all the way up? So we are sitting right in the very last segment at the end of that graph. So we need to look at where are we in a trend and where are we in short-term volatility. And that is important to the business, that we are reacting, probably a better word, responding to a market circumstances, to a trend, and to the short-term activity. So what we're looking at is to get the peaks or the troughs, depending on whether you're importing or exporting, and making sure that we are on average ahead of the greater trends that we are working with. Now, if you were 100% covered, you are absolutely never going to be able to do that. And if you're 0%, you're never going to be able to do that. But if you're going for a degree of hedging, this can be achieved because you're allowing yourself to use the best rate every time you make a decision. Am I cover or spot, which is better, and therefore having a direct profit impact. So if we look at the various solutions we can deploy in our organization, and we, for example, we say, well, we have an expectation we're always going to do the best. And I've seen Forex policies that define we've always got to do the best. Well, you can't, because you don't know what the best is where you're sitting today. You don't know what's coming down the road in terms of the market, the trends, market conditions. You don't have any idea of what that is. But there is this perfect science of hindsight, where that will tell you what would have been the best thing to have done on anything. And to the point of the 14 rates that we look at, we do look backwards and say, what if I had been fully covered on the day I placed the order? Had I been fully covered on transfer of risk? Had I been fully covered when the stock came into my store? Had I been covered in terms of a portfolio? What was the average trend of the market? What was the spot rate on the day? What was the rate I actually used? So those are just some of the ones that we would look at. There are then sales cost, accounting cost rate, revaluation cost rate. There are various other internal accounting rates that you might be using, which are creating the gray area in the Forex management element. So those can also be looked at and compared against actual cost or receipt to company of what we call the effective rate. Now that we have covered and talked about in earlier sessions, the effective rate being the overall business outcome of a foreign exchange transaction. And I use those words in business terms, not accounting or cash flow terms, because that is very different. So if we look at the important decision points that do exist in our Treasury Manager's day here, is the decision to take out hedging. In other words, just consider the current rate to be the rate at which we want to protect the business because we like the rate for whatever reason. Better than cost, better than we've seen before. It secures a profitability position. It allows us to sell it competitively, whatever business reason we are making. We then have to define how long is that instrument going to be taken out for? What is its definitive maturity date? Are we taking it to a Friday because that's what we deal? Are we taking it to Monday because that's when we do our admin work and all our payment runs? Or are we taking it to the last business day in the month? Or we're particularly not taking it to the last business day in the month because of the liquidity pressures we might have on that day. So all of these things need to be taken into consideration. Also, what is the invoice date? When are we going to be doing payments? Do we pay on exactly the defined date, or do we combine them into payment runs? So we also then have to look at the composition. What is the instrument we're going to utilize to take this hedging and to be able to utilize it in an appropriate way? So the other decision is, are we going to be purchasing some spot or utilizing some hedging we've got at the point that we're going to be doing the conversion? So again, we've got another decision-making point. We also have short-term decision windows. So if we know we've got an accounting rate for the month, we're looking at just the current month, we're looking very narrow focused at a moment in time, we're going to make many decisions during that month to look at protecting a very short-term rate. Next month, we start the game again. So it's another way some companies will manage their foreign exchange, and that is accounting-driven rather than business-driven. Decisions then will naturally occur because of the nature of the business. The contracts will invariably come to maturity and they have not yet been used, either because I've used spot, underlying business has changed. We defined that rate, that date, because it was the best interest rate date to take it to. And we now are into the element of extensions. Up until now, we would have done drawdowns because we've utilized a lot of cover in the months ahead. But at a point in time, we'll get to cover that has not been used. That is no problem. We then extend it based on interest rate strategies and business liquidity and needs. We take that to a future date. And we'll talk in a moment about how that actually can happen. It happens in various ways. So the important part of this is a lot of companies, we often hear people say, oh, but the cover is on that day and I can't pay on that day. So the cover's on that day because it's just on that day. It has no relevance or importance to when you, from a business perspective, need to make the decision to make a payment or receipt funds. Those are done for business reasons, credit reasons, relationship reasons, liquidity reasons, bringing things into stock, transferring risk, all sorts of other business reasons are the reasons you will make the decision to convert from foreign currency to home currency or vice versa. Not because you took an instrument a few months ago and it's now going to define you. It does not. You define what is going on. So when we look at instrument creation, what are the things we need to look at? We can be very complex or we can be very, very simple. We need to consider the cost of an instrument, its flexibility in its makeup, the way it's going to behave at the beginning, during, and at the end of its life, and what is the overall outcome to the business, liquidity-wise, credit-wise, use of facility-wise, risk, types of things that can go wrong, what is its worst-case scenario, what is its best-case scenario. And we see a lot of these complex instruments that all those elements start to come to play. But actually, if you look at it, the best way to manage foreign exchange is to stay with the two vanilla instruments only, spots and the vanilla forward. That way you manage the costs, you manage the duration, you manage the impact. Often we see suppliers providing various instruments that we will talk about in a moment that actually have got a lot of cost built into them, but more importantly, they've got a high degree of risk built into them, and they don't always behave the way you thought they were going to behave, and therefore the risks that they have inherently come to pass. So when we look at the structure of a instrument that we have taken out, we've got the rate at which the spot was at that point in time. We have an interest rate element that impacts the time element, and the interest rate impact the overall pricing of it. And you have sometimes no control over what the market's going to do once you've established your instrument. Now, if you've established a vanilla forward, it doesn't matter what the rate does in between. It's not going to change anything. What it does allow you to is to buy spot instead of using your instrument, or to draw your instrument down early because that's the best thing you can do, and you only pay for the time period that you've used it. So if you took out a 3-month contract and after 1 month you decided that was the best instrument in your portfolio and you wish to use it now, you draw down and you pay for 1 month's worth, or you receive 1 month's worth of premium discount respectively. A lot of the other instruments don't do that. They build in either none of your discount or all of the premium, even though you only used a month. You end up paying for 3, And if you're in a discount, you get none, even though you should have earned a month. So your, what do they call, derivative instruments, your participating forward, your options, for example, collar, floor, combination, various options, your window forwards, all of those have actually got a high degree of cost built into them. And they look simple, they look flexible, but they're extremely costly. And yes, from an accounting point of view, it doesn't require the same degree of understanding to do things the right way for once you come to utilizing them, but you are throwing away anything up to 4%. And 4% of your foreign exchange is not something to be sniffed at, because you've built cost in and you've not benefited in the ways you should have done. So we do recommend utilizing the vanilla forward, which means that the forward contract rate that you get is applicable for the last day in the contract only. That doesn't mean you only use it then, it means that rate only applies to that day. If you utilize the instrument earlier, you will get the benefit of time change between where it started, where it ended, and where you used it. So you will always get something that is directly relevant to the time period. And that is achieved through swaps, early drawdown swap or an extension swap. But then also we have the ability to be able to build those into what we call rate changes, adjusted rates swaps. So instead of having multiple cash flows at the time of swaps, because swaps are always based on the current market rate, not on the forward rate that you have. So you end up with positive and negative flows in the middle and at the end, for example, but together they equal technically exactly the same rate as the adjusted rate. The adjusted rate being simpler from an accounting perspective, and therefore from a management perspective, it has a degree of simplicity. But the if you wanted to have control and you were managing it yourself with the bank, a adjusted rate does offer an opportunity for margin creep to go in there, and for the provider of the currency to actually take more pips than they should do. And it's more difficult to identify that. So there are positive and negatives of both, and the swaps definitely having an impact on liquidity. And it's invariably very difficult to plan in advance for those. And we do see great excitement when these kind of swaps occur. If you are dealing directly with the bank, you only have that choice in most cases. And if you're dealing with a broker, you do sometimes have the choice of the adjusted rate. So it's something worth considering and discussing with your provider, but understanding the risk elements that exist in it and the benefits that exist. So back to the human element I wanted to talk about in the beginning is the brokers and banks are made up, the institutions, organizations, businesses, but they're made up of people, platforms, and rules. So people is about having a relationship with somebody and saying, how do I do this? What are my options? What are the prices? I made a mistake. Can we fix things? Don't like that rate. Can you help me with a slightly better rate? That margin's a bit high. And you have an interaction. On a platform, it's a case of that's the rate. That's what you take. There's nothing you can engage in. It's either accept it or reject it. There's and a high degree of risk and difficult to fix any errors that you've made. But also organizations have their rules. You cannot do. You can't place an order, for example, for less than 100,000 of an element size, or you can only use swaps. You can't use rate adjustments. You have to take the way you can use your foreign currency accounts, for example. So all of these organizations have different rules, how their credit might be defined, how they will review your balance sheet to give you credit, how they might do the mark to market when the markets are very volatile, how they might call for extra security if they need it. All of these things are different, one supplier to another. So it's very important that you get to understand what your supplier can offer and to work with them to get the best from them at all times, according to your credit line, the headroom on it, its utilization, the variations that can impact it. it's a number of times you'll see you have a credit facility and you think you've got 200,000 headroom in your facility, and you try and borrow 10,000, or your overdraft goes up by 10,000, and find out you've hit your limit. And invariably, in volatile times, the Forex element of your portfolio has had a factor of utilizing more of the facility as protection to the bank. So you might find they would normally take, let's say, 5% of the value of your forwards, but under volatile times, there's a factor, and it's now turned into 10%. So the Forex element of your facility is doubled just in 1 minute. Some banks, if you use swaps, will double the usage of it. Others will halve the usage of it. So there's various ways in which credit facilities are built and utilized. Now we come to the real human element, that of behavioral science. And we do know from the science that humans are biased. Every single one of us is. And if we think we're not, it's called a metacognitive bias, which means we don't think we're biased when actually we just have to accept we are. And the most important thing is to understand what are the tripwires you can put in place to stop yourself being biased. So is recognize your biases and make corrective thinking because of what biases you have. And we do have them, and we need to be able to say what are, there's known as the 12 questions, based into 3 things. Ask myself what I might be doing wrong, ask the provider of the information, and looking at the element itself that we're making a decision on. And if you look at those 3 components, the 2 human, the 1 physical, and we ask the right kind of questions, we can invariably uncover if somebody has got a positive bias, a conservative bias, a greed bias. Those are some of the most typical ones that we see. And the result of these various biases is we invariably delay a decision. We often go for a non-decision because of our biases rather than making a definitive decision, particularly when things are not perfect and they're not going the way we want them. When they're going perfect, we get greedy and we want more, and we don't make decisions again. And again, at the moment we should make it, we're not available. We're busy. We're in a meeting and the moment's gone. So we then think, okay, well, let's wait for it to come back again. And again, behavioral science, the behavior of humans comes into play, and you might never see that again. So in Forex management, the important thing to do is to define what is an acceptable rate, what is a good rate, and set that in stone in the way through using market orders. And when it gets there, it triggers. It happens, whether you're in a meeting or you're not in a meeting, or you're feeling greedy or you're not feeling greedy, provided you leave those orders alone, the decisions you made in a logical, practical moment in time play out without the moment of excitement and influence having a negative impact at that point in time. So at this point, we come back to our framework. We've done value, we've assessed, we've learned, we've understood, and now we've found all the things we need to do about the instruments and how we're now integrating, for the first time we've been talking, of how we're integrating the external environment into our business and making the decisions for the uniqueness of our company. So as we said right from the beginning, we have a circumstance that every company is different. Their risk profiling is different. Their accounting is different. The way they price to the customer is different. And what we've learned today is the human influence in the knowledge space. So how do we, as knowledgeable or not that knowledgeable people that are influencing the decisions being made by the company, how are we impacting those in a positive or negative way? So if you look at the things we've covered today, we've covered the policies, accounting, decision-making, the kinds of actions we might take. We haven't covered reporting. Those we have got in other elements of the framework. We've talked about reporting. We've also talked about the people, the kind of technologies that might be in play, the current experience we might have, as well as the business and how that is playing out. So if we look at the different components that I've covered during this session and previous session, we start with the spot rate. We then add in the element of the interest rate, which is time, and it's the interest rate differential between currency pair that we're working on. So the difference between, for example, the euro interest rate and the sterling interest rate, we might be seeing anything up to a 2% variance. That 2% is either a benefit or a cost, depending on whether you're importing or exporting from whichever country. We then have time. When do we want the cover? When do we need the cover? What is our supply chain? How soon in that risk journey have we made the decision to interact with the market and decide that we're going to take cover at the current spot rate? So we have a time element. We have all the different instruments that we could use, and we've talked about a few of those today, lesser or more risk. And then we've looked at the providers between banks and brokers and how they might be able to add complexity or bring better solutions for us. So a lot of companies that we speak to say, well, it's no problem. We'll go to our provider and we will get advice from them. I know from experience that people in banks and brokers do not have the knowledge about your business that you should have. And invariably, you are not as knowledgeable and therefore don't ask yourselves all the right questions to come to the right decision as to what decision you're going to take. So the risk the providers bring is they bring a newbie to the table, a new way of doing things, and it looks good and looks sexy, and we utilize it. Or they might say, and they might be influenced, I'm being a bit unkind here, but they might be influenced by internal targets. They need to have so many trades, so many million done by the end of the month, and it's 4 days to go. They will start pressurizing their portfolio to act, and therefore they make their trades. So they are internally driven. They're not driven first by you. They're driven by the market, by the internal benchmarks that they have to work to, KPIs, and third comes yourself. So if you look at your business, you should be in the position that you know the business first. That is so critically important. So we've correlated then and understood our business and therefore can make better decisions in the Forex market. That felt like a very sudden end to it. But what we are making sure of is that the human element that we are dealing with all the time is allowing us to assess our business, understand how Forex is operating within our company so that we can make the best commercial business decisions on our product that we're selling or buying, and that therefore we are maximizing our gross profit and ultimately our net profit by being efficient in what we're doing. So many processes we know are not as efficient as they should be in organizations, and the process leads rather than doing the right thing leads. And we see this so often when we're working with companies, particularly when we first begin with a new company. We typically are seeing anything up to 4% that they are throwing away, not being able to count that, not being able to see that that is happening, and thinking that they can do it in a way that they don't need to manage the foreign exchange. So years and years of experience, 35 years, I think probably even 40 years in the market, and over 200 companies that we've worked with globally, we are seeing certain patterns where managing foreign exchange can definitely be beneficial for an organization. There are big companies that have treasury departments that have the kind of expertise that you need, and they are operating global central treasuries. Those are not the companies I'm talking about. There, I make the assumption they've employed the right people and the right technology and have the most appropriate accounting policies and reporting so that they're making the right decision. A number of assumptions, but being the average company, large business, small business, that you do not have the luxury of being able to afford the knowledge that you need to bring in to manage your foreign exchange. So it is important that you learn from what we're talking about today, or to look to outsiders who can provide those solutions for you, as long as they look to you, the business first, which is what Valufin does and has been doing for 30 plus years in many countries. Our two main countries that we do operate in is the UK and South Africa. but that's not the only markets we work in. We work in many, many other countries where we are providing these kind of corporate solutions. Next session, we'll go on to the I and then the N of Valufin, and then we will be looking at pulling this all together in a summary session, and then you will be able to look out for the articles and then the book. But in the meantime, you've got these recorded webinars that can help you build the kind of questions you need to ask yourself as to whether you're looking after your foreign exchange properly. And these are the kind of things that your risk committee or board or finance department should be starting to build, that internal, what are we doing under these circumstances? What are the things that could be standing in our way, and how do we mitigate those? So I wish you all lots of good fun, lots of Forex profit, and to make sure that you are looking at it in a way that you can see through the cloud and understand what is actually impacting your business, so you do ultimately make the right commercial decisions. So thank you very much for everyone for attending today. I appreciate it, and I wish you the best for the rest of the day. Thank you.